From the University of Westminster, this is The Week Ahead with Dave Coker.
November 1st, 2020. Welcome to The Week Ahead. My name is Dave Coker. Let's see what's going on over the next 5 days in the markets. All right, key events. As always, we talk about things that you have to pay particular attention to. The U.S. elections front and center. My God. A lot of volatility in the markets last week. That ties into the second topic, Wall Street. Some people believe, I should say, that the market is pricing in a Mr. Biden win. I'm not totally sure. I think there's some fear about Mr. Biden's win, and especially some of his policies. We'll be talking about those a little bit later in a little bit more detail. That might have accounted for the sell-off, but still, the market was really overvalued, and we've been talking about various indicators, price to sales, price to book, just the performance over various periods of time, 3 months, 6 months, 1 year. And it's been pretty crazy, in particular since the April lows that we had when the corona crash happened. We've got a Fed meeting coming up. We'll get the minutes. We'll see what's happening. U.S. jobs report, a big one. Pay attention to that. We'll see if America's going back to work or not. And the Bank of England is having a meeting as well. So since we live in the UK, we sort of have to pay attention to what's going on there. All right, we're going to look at some of the metrics, guys, over the past week. So here we go. We got S&P 500 over the past 1 week. And you can see we got pounded on in a major way. Amazon, Apple, Microsoft, Facebook really got spanked hard. But the selling continued pretty much across all sectors. And it wasn't one of these weeks we've had them where absolutely every stock was down. You can see a little bit of green on the board. But still, it's pretty interesting that we see such sharp sell-offs in material there. Earnings, now I thought we'd take a look at EPS, earnings per share growth over the past 5 years to see if we could try to get an idea about why these companies are hitting such record highs. And you can see Microsoft and Amazon have fairly decent growth over the 5-year horizon, but look at Apple, only up 7.3%. How do they justify that share price? The share price is going nuts. And what that means is the multiplier, the price to earnings ratio, in other words, is getting much, much larger, as we've seen before. Other companies, you can see they've actually had a drop in EPS growth. Look at the energy companies down there on the right-hand side, all the way to the bottom, second row. You can see Exxon and a couple other energy companies gotten pounded on in a major way. It's been a very challenging operating environment for energy over the past 5 years for lots of different reasons. And we can't get into it now. But once again, this gives you an idea. Are share prices justified by the growth in earnings? And maybe with Amazon, you might be able to make an argument for it. Microsoft, perhaps. Apple, even Google's a little shaky there. Facebook, I don't have a read on that. All right, where are you going to be putting your money, guys? Now, Mr. Biden's got lots of interesting proposals. I'm not going to say crazy or anything like that. They're interesting. And one is he wants to sharply raise capital gains taxes. Now, what will be the net effect of this? Well, let's talk about what a capital gains tax is. In the States, we've got short-term and long-term capital gains. And what we're looking at here is long-term capital gains. In other words, if you held the stocks more than 1 year, presently you can see you're taxed at a rate of 24%. Mr. Biden wants to push that up to north of 39%. My God, it's really amazing how high he wants to make the capital gains tax. What will be the net effect of this, guys? Well, a lot of people in the States, I'll raise my hand here, I've got assets in the States. We're sitting on fairly robust capital gains. In particular, if you've bought stocks and held on to them, as I do, I've got some stocks that I've owned over 20 years, they're up thousands of percent. Now, my situation's a little different because I invest only for income. I'm not really going to sell now when Mr. Biden gets elected, because once he assumes office in January, he'll change the rules. I'll still get the dividends, but a lot of people will be dumping. And as usual, guys, when you see these huge activities like this, it's actually probably a good time to sit back and take a look at what's being sold, where the price is, look at the various multiples, and maybe go in hard. I'm certainly building up liquidity. I haven't really done a great, I've got risk capital in the stock market, just sitting there, and in my brokerage account, I should say, and I'm just waiting for a buying opportunity. I've dabbled around the edges, bought a few things, but nothing significant. And if Mr. Biden does indeed raise capital gains taxes so sharply, then yeah, I think I might be grabbing some stocks. Remember, we've talked about commodities. We talked about the commodity collapse over the past couple of weeks. Well, look what the hedge funds are up to, guys. the hedge funds are starting to take positions. And they're taking positions because they have a view that maybe commodities are going to spike up in the near term. Now, guys, ignore all that garbage about the smartest people in the room. I don't buy that at all. Hedge funds can and do make mistakes. But still, when you see such a sharp increase, really huge, over such a short period of time, that tells me that something might be up. It might actually come to fruition this time. Here's a good one. Now, I've got a really good presentation about cycles in capital markets. And for those of you who are in my class and we take a look at various topics before we begin the presentation, you'll be seeing the presentation on cycles sooner rather than later. But here we go, guys. I've got the Dow 30. And on the left-hand side, we've got 2009 to 2020, the scale, the left axis, and left vertical axis. And on the right vertical axis, we got 1919 to 1932. There you go. Yeah, I have really said the crash of the global financial crash that we had back in 2007 to 2009, that really wasn't a repeat of 1929. It was more like what's called the Panic of 1907. And then 22 years later, we had a really sharp crash, the Great Crash in 1929. I think it's the same thing this time around. I've been saying that for a long period of time. Here's an interesting one, guys, and I'm frequently asked a bunch of questions about Mr. Trump and voting and things like that. No, I didn't vote for him last time around. Not likely to vote for him this time around. I'll tell you something about Americans, guys, though. Americans vote with their stomachs and wallets. I won't even say it's number one, number two. It's pretty much the first thing they look at. Are they hurting financially? Can they feed themselves? Are they having any trouble there? And are they liquid? And this was actually run in October. So this wasn't run, September, I'm so sorry. This was actually run fairly recently in September. And you can see a large percentage of Americans actually say they're better off with Mr. Trump. So once again, guys, I do have to point out when people ask me and they point to what the free U.S. media is predicting, a landslide for Mr. Biden, I am old enough to remember the election of 2016. And I remember when the media was saying the same stuff with respect to Hillary Clinton. So I'm very, very dubious. And all their explanations about why this time is different, I'm not buying. The race is very, very close. I have mentioned, I should say, that when you look at free U.S. media, they're predicting a Biden landslide. When you looked at the financial media that I get the bulk of my news from, the financial media is saying Trump has an extremely good chance to win, and the race is very, very tight. It doesn't mean he's going to win, but they're predicting that he's got a better chance of winning than what the press says in the States. Okay, let's start in with what we're going to do for the next 5 days. Oh, guys, you'll be happy to see I fixed my animation. You're getting it all at once. All right, so Monday, November 2nd at 10:45 a.m., we got manufacturing PMI, the Purchasing Managers Index. Remember, very simple metric. I love it. It's extremely simple. I'm stupid. Basically, it says if it's greater than 50, it means optimistic. It means growth, I should say. If it's less than 50, it means contraction. And so you hear, and this is very similar to some other metrics we've looked at with consumer confidence. So you hear the previous was 53.3. We don't have a read on the forecast, but yes, manufacturing is recovering. It's in an expansion mode. Construction spending month to month for September, previous was 1.4. Forecast to come in at 1.9. A lot more construction going underway in the States. At 11:30 hours, we got 3-month and 6-month T-bill auctions. The previous for each one was, for the 3-month was 0.1, 10 basis points essentially, and for the 6-month it was 11 basis points. Now, to put it in context, guys, I've gone back 20 years and I've charted, I should say, the yields on the 3-month and 6-month. And you can see presently, look on the right-hand side of the graph where we are now. We're really down where we were in 2009, and both of those are much, much lower. We're really down, for right now for the present. And it's the same thing back with 2019. And you can see we're much lower than we were with 2009. It's a really interesting period when interest rates are dropped so significantly. Tuesday at 0900 hours, we got the U.S. presidential election. It kicks off. And actually, I don't know why I put that time in. I think some of the polls do open about 7 a.m. But pay attention to that throughout the day. I would recommend not watching news coverage in detail. Maybe check out and get a headline or go on Twitter and get some information periodically. I tend to throttle my news for fast-moving events like that. You can't really keep up and try to understand exactly what's going on, so you got to throttle it. At 1100 hours, we got factory orders month to month for September. Prior was 0.7%. Forecast for an uplift to come in at 1%. And then here we've got the economic optimism. I was referring to this metric when we did PMI. It's the same thing, guys. So basically 55, anything north of 50, 55 in particular, indicates optimism is improving. If it was below 50, it would mean optimism was decaying. People were feeling less optimistic. People are feeling much more optimistic about the economy. On Wednesday, November 4th, at 0830 hours, we got exports. And this is the one you got to pay attention to get an idea about the trade balance. Prior was 171.9 billion. We don't have a forecast. Imports. Prior was 239 billion. Do the math, guys. We just import far more than we export. And in spite of what internet economists claim, yes, this does matter. Basically, what's going on is America is exporting wealth to other nations. And that is part of the reason why living standards in the United States over the past 20 odd years have fallen, and other phenomena that we've witnessed. At 0915, we got ADP non-farm employment change. This is for October. Prior was 749,000. We're forecast to come in at 650,000. At 1130 hours, crude oil inventories. Prior 4.32 million. Pay attention to it. It will indicate, all other factors being equal, meaning production, if we see inventories rise, that means likely the economy is slowing, and we're seeing the demand for oil fall. So pay attention to this, real important. Wow, pardon me, I'm so sorry. On Thursday, November 5th. Now, this is something we haven't talked about before. These are the Challenger job cuts. And here what we're doing, guys, we're looking at job cuts from an independent organization, not the government, that tracks this data. So we're looking at how many jobs were cut year on year for November 5th. And you can see year on year, it was a 185.9% increase. A stunning, huge increase in the number of jobs cut. It all gets back to the corona crash. If we take a look at job cuts for October, the prior was 118.804 thousand. So put the math together, guys. These are huge job cuts. We don't have a forecast on this, but I do like to look at the Challenger data because it gives me a good comparison to government data. At 0830 hours, we've got jobless claims, 4-week average. Prior was 811,000. We're forecast to come in at 780,000. And once again, I put that in there twice. I'm so sorry. I didn't delete it from last week. My apologies. All right, on Friday, November 6th, at 0930 hours, we got average hourly earnings year on year for October. Prior was 4.7%. We're forecast to come in at 4.6, a slight drop, nothing significant. At 0930 hours, we've got average hourly earnings again month on month for October. Prior was 0.1%, forecast to come in at 0.2%. At 0930 hours, non-farm payrolls, real significant number. Prior was 661,000, forecast to come in at 600,000. A little bit of a drop there. Now here's an interesting one, and again, I like to look at these metrics because the government, in the States, we have 6 different ways of reporting unemployment. And what a surprise. They're named U1, U2, U3, U4, U5, U6. And the difference is, guys, as you look at U1 to U2 to U3, U3 is what the media reports, U4, U5, U6, they become increasingly broad, the definition of unemployment. So with U6, we're looking at everybody, long-term unemployed as well as short-term unemployed. And here you can see it's at 12.8%. We don't have a forecast. We're not totally sure what's going to happen there. All right, guys, this has been the week ahead for November 1st, 2020. My name's Dave Coker. Have a great and profitable week. There's no reason why you can't go ahead and make some money. Personally, I've got liquidity. I'm going to see what happens because of the election. I've got my eye on a lot of stocks, dividend paying only though. And if they crater, I'm buying. All right, guys, once again, have a great week. Take care.